Hey, so this financial projection template is built specifically for multifamily apartment investors who are looking to acquire a property, maybe renovate it, and then perhaps increase the rental rates in order to earn a return on that investment. It's a pretty complex template, has a lot of really meat and power behind it, and I'm going to walk you through how you can use it. First, I'm going to kind of go through just at a quick high level, show you what's available in the template, and then I'm going to kind of follow that back up with, in more detail, really walk through step by step how to fill it out. Also, if you stick around to the end of the video, as a thank you for that, I'm going to show you how to get access to a coupon code that you can use for a discount on the template. As a thank you for watching through all of this. I guess before I really dive in, just a little bit of background about me. My name's Adam Huxama. I'm the co-founder of Projection Hub. I started Projection Hub with my brother about a decade ago. I was working as an SBA lender, a small business administration lender, making loans to small businesses. And a lot of our clients needed help with projections. And so I thought, hey, I'm going to create this software tool that is going to help people create financial projections, and we're going to charge this monthly recurring fee, and I'm going to build up this big tech business. And my brother was a software engineer, so we actually tried this. We built an app and to help clients build financial projections. And you know what? It turned out after doing this for about 10 years, we realized, you know what? Excel is still pretty good. Excel still is quite powerful, quite flexible. It's just really good. And it's what lenders and investors often expect to be able to use for financial modeling. And so we pivoted, and today we sell financial projection Excel templates, spreadsheet templates for all sorts of different industries, about 100 different industries. And particularly today, we're going to take a look at this multifamily apartment investor template that I think is really powerful. And so with that background, I'm going to go ahead and walk you through this model. And I will mention just kind of off the top here that all of our templates are built by our CPA, our in-house CPA as well. And so you can kind of rest assured in that we have a CPA that has built this model as well. So I am going to start here on the at a glance tab. So this is a number of different charts and graphs and tables that you'll get kind of at the end of the process. You'll also have a number of different financial statement charts here. So we've got a 10-year cash flow statement. We have a 10-year balance sheet summary, 10-year income statement summary. We've got the cash flow statement, balance sheet, and income statement all broken down by month for all 10 years. So if you really need that monthly detail, we have that available as well. There's a couple other cool reports here. So there is a pre and post acquisition comparison chart here. So what this does is once you've got everything entered, you'll be able to see here's what the income statement, basically what the cash flow statement looked like the 12 months prior to acquisition. Here's what it looks like after we've acquired the property, renovated it, maybe increased rent rates, and implemented our new operating system as investors. And you can see what the difference is. And so, a lot of times at least the idea of this template, the use case is, you're trying to acquire a property that you think you can manage better, that you can operate more effectively. This is kind of that comparison chart for you. You'll also have this input distributions tab once you're done. So you will be able to kind of model out the sale of the property. So if the hope is like, hey, we're going to raise some investment, we're going to get a loan, we're going to acquire the property, we're going to implement our system, we're going to improve it, improve net operating income, and then ultimately we're going to sell it. And you want to see what the potential return on that investment can be. We have a simple kind of IRR calculator and some other cash on cash returns and different return metrics here that you can see. So what it'll do is it'll take your cash flow projections. It'll assume, hey, we can say what percentage of our cash balance do we want to hold in reserve versus distributing to investors? And then ultimately, when are we going to sell? So here we're saying we're going to sell this property after 10 years at a 7% cap rate. And based on that and the equity investment that we had put in, we are expecting to generate a 19.2% IRR. We'll kind of maybe come back to this at the end to be able to look at this in a bit more detail. But if you need a more complex, like waterfall distribution model, you can always reach out to us at support@projectionhub.com, and we can always customize distributions model for you. This is kind of your bare bones model here. Okay, so I'm gonna now go into the input tabs here and really dive in more detail about how you actually fill this out. So we've got our input revenue tab here, and we're saying, okay, we're gonna, the projection start month is January 1st, 2024 here. And we have 3 different unit types: a studio apartment, 1 bedroom and 2 bedroom. We have the number of units. So we have a 100 unit complex, You see the square footage for each unit type, the rent per square foot. So this is the starting rent, kind of prior to acquisition, like this is what the prior owners were charging. And then you can say, okay, here's what we're going to charge. Here's the rent per square foot after we acquire it, or maybe after we acquire it and renovate it, this is what we're going to increase rents to. And then you have the ability to say, okay, we're going to start changing rents, increasing rents in all of these units on a particular month. Let's say for us, it's month one. Like we're going to acquire it, we're going to start increasing rents, and it's going to take us a while to increase rents for all units. So we're saying by month 12, we'll have increased the rent rate for all the units up to the new level. So that's what this means. Now, if you're saying, nope, we're going to acquire it and we're raising rents, within 3 months on everybody, you could put in month 3 here, right? So here, yeah, we'll assume that it's going to take us 12 months to rent out to increase the rent on all the units. Now, we also have the ability to add additional revenue per unit per month. So we're saying, hey, maybe, some folks are going to pay us for parking, some for storage, in addition to their rent. Now, if we scroll down, what we'll see is you have the ability down in this table to say, okay, not every tenant is going to pay that extra for parking or for storage. So we're saying, okay, 20% are going to pay us that extra. 20% of our tenants are going to pay us that additional revenue for parking, 15% for storage. The other assumptions you can see down here, you can increase the annual rent by a percentage here. So we've got that set to 3% increase. You want to be more aggressive, you can do that. And then also you can adjust the vacancy rate. So we're saying in the prior year when we acquired the property, it was at 7% vacancy rate. We're going to drive that down over time from 6%, 5%. We're going to hold it steady at 5% vacancy rate. And ultimately all of this will help you forecast your gross potential income and your vacancy and credit loss, and then ultimately your EGI, your effective gross income per month. Okay, so moving on to our input operating expense tab. So you have the ability to enter in a number of operating expenses here. You can categorize them. So you have a drop down that allows you to pick a category from this list of 10 categories. And then you can select a cost driver. So you could have expenses that are kind of attributed to the entire property. You could have expenses that are a per unit basis or a per square foot basis. And so for this example, let's say we're going to have a grand reopening marketing campaign, and it's going to last for 3 months, and it's for the entire property. And we're going to spend from month 6 to month 9. We're going to spend $5,000 a month. And then we have this option here to say, does this expense repeat each year? Well, no, it doesn't. So we're going to select no, because this is a one-time expense during that grand reopening. Now, an example of an expense that is kind of a one-time expense, but it does repeat each year would be down here on the real estate taxes. So we added real estate taxes here. You could do this on the entire property. You could kind of estimate it on a per unit basis. So there's different approaches. We're saying, hey, this is on a per unit basis, and it's $1,750 per unit per year. And it repeats on month 9. So we put the first payment month 9 and last payment month 9, but it repeats every year on the 9th month of the year. So now the rest of these expenses, you can see, we have like maintenance, interior maintenance, and we set that up as an expense as a per square foot basis for maintenance, interior and exterior. We're saying it's going to be 5 cents. We're budgeting 5 cents per square foot for interior and exterior maintenance. Again, this will allow you to increase those expenses by a percentage over time, year by year. Now, this little section here is really useful because what it allows you to do, so these numbers in gray are going to be what you're forecasting to do based on these assumptions that you just entered in. So, if you want to know, okay, I'm going to spend 5 cents per square foot on interior maintenance, well, that amounts to, based on your square footage, $52,500 per year. So this is calculating all your different expenses based on these assumptions. This column is allowing you to put in the historical, what the prior owners had for these different expenses. So again, the idea here is to help you make a case to investors or lenders that help give us the financing to be able to acquire the property, and we're going to operate it better. In order to be able to show that, you really need to be able to put in, kind of the baseline. What were the prior owners paying for these different expenses, and be able to compare that. So you'll put in, what those expenses were prior year here. Couple more things to mention here. You can actually add expenses as a percentage of revenue. So we have set here an operations manager that we're saying is going to be paid 7% per year. And we're saying the prior year was actually 10%. So maybe the prior owners were paying somebody 10%, but maybe we're going to do more of the operations in-house, and it's going to cost us 7% per year for operations. And then we have a general and admin expense assumption of 3% of revenue. So you can add other expenses as a percentage of revenue if you'd like as well. You can also add in a reserve for replacements here to set aside some reserve. All right, so now we can go to our input salaries and wages. Now, you have the ability to kind of, input your wage expense as a percentage of revenue, or if you want to budget that on a per square foot basis. If you say, we spend 5 cents per square foot on staffing, you could budget it that way, or you can kind of put in, more manual, like we're gonna have this position paid this salary, and so on. And so that's what we have here as an example. So we're saying we're gonna have an on-site facilities manager making $80,000 a year with employer taxes, annual benefits, starting in month 1, ending in month 120. So like the whole 10-year model. And we only have one of these particular employees, and we're gonna give them a 2.5% annual raise. And we have maybe one maintenance staff person on staff, or maybe a couple part-time, and we have their salaries here. You can also put in the prior year annual payroll expense up here in this field again to be able to compare to what they were doing in prior years. All right, so now once you have done all of that, I'm actually going to jump first to the input purchase and renovation budget. This is a bit of a circle, right? So you need to kind of put in assumptions on what's it going to cost to purchase the property. Then you're going to go back and forth between the purchase and renovation budget and this financing tab to see if we can make the financing work. And so I'm going to finish up with this kind of circular reference section here. So we're saying in this example that the property purchase is going to be $14 million, and we are going to do unit renovations. So we're going to spend $5,000 per unit for all 100 units. So we have a $500,000 budget for unit renovations. We're going to paint the exterior of the property for $150,000. We're going to repave the parking lot for $150,000, and we're going to spend $50,000 on signage. So our total cost here, total expenses, $14,850,000 with acquisition and renovation. You can see here there's a cost period, so you can here like the acquisition of the property is all going to be in month 1. So start month, end month is month 1. But maybe the unit renovations are going to happen over the course of the first year, and so that'll spread out between month 1 and month 12. So this kind of is the cash flow of your acquisition and the renovations that are happening. You can kind of see how that will work. You can also add in fixed assets that you're going to purchase or have expenses down the line. So maybe we're going to have some new equipment that we know we're going to have to purchase, right off the bat for the maintenance team. So we got $15,000 worth of equipment, and we know maybe we should set aside some cash for upgrades to our HVAC systems for $200,000 here in month 60, so 5 years in. And maybe we need a new roof in month 72, and so we budgeted for that as well. So maybe useful life there should probably be longer than 10 years. Okay, so this gives you your kind of budget. This is what we think we're going to have to spend. Now we need to go back and figure out, can we actually afford this? Can we come up with the financing we need? And so this is a bit of a game of back and forth to try to figure this out. So we're going to say, okay, we are hoping that the bank is going to allow us to have a 1.2 debt service coverage ratio, and we're hoping for a 6% interest rate over a 360 or 30-year term. Based on these assumptions and the net operating income of the property prior to you buying it. So we kind of expect that the bank they might look at your projections and say, okay, we'll lend to you based on how we think you're going to operate this from a net operating income in the future. They might also say, no, we're gonna base it on how the property is currently operating, and that's what we're gonna lend against. And so the idea here is we're saying this is the maximum debt you can get based on the prior year's operating income or net operating income, and this debt service coverage ratio requirement. So we're saying, okay, 10.7 million is what you can borrow. Now here, once you've increased the rents and made those renovations and you've stabilized, so this is going to look at, okay, the month the property is stabilized is month 13. And our monthly net operating income has increased from $77,000 to $95,000. So that means we can afford a larger loan payment. We can afford more debt service. So we can actually afford a $13.2 million loan. And so the goal here could be to try to acquire the property with this debt and equity, and then get the property up to speed, and then do a cash out refinance to pay off some of those equity investors as quick as possible. So what you're going to be able to do, so this is all kind of just information up here. And then down here, you can say, okay, we're going to have this kind of mini perm debt, the first loan we're going to get to acquire the property at $10.7 million at a 6.5% interest rate. And then our goal is by month 19, we want to do a cash out refinance to more permanent debt. And with that, we think, based on this information up here, we think we can borrow $13.2 million because that's what this table is telling us. All right, and so then with each of those loans, with the mini perm debt and the cash out refinance permanent debt, you're going to have loan financing costs, appraisals, under legal, loan closing costs, all those sorts of things, right? So we set this is an equation right now. It's set to take the total loan times 2%. So it's assuming a 2% loan financing cost. But again, you can adjust all of those. Now, we can also enter in a target debt to equity ratio. I put in 2.5%. Now, based on the equity that I actually entered in here, we're at 2.38%. So this is red. It's basically just telling me that, hey, you said your target was 2.5 and you're at 2.38. So you're a little off of your target. So that's why it's kind of yelling at me in red. So, but with the 4.5 million and the 10.7, so we've got the total debt entered of 10.7, equity entered of 4.5, gives us 15.2 million. And our purchase and renovation budget was that 14.8. We had some other fixed assets of 15,000 plus financing costs, leaves us with $76,000 worth of working capital to operate after we've closed on the property. And so this is all, since this is green, that means, it looks like we're working here. Now I just want to mention, this is going to yell at you if it doesn't think your assumptions are going to work. So let's just say we needed to have a 1.5 debt service coverage ratio for some reason. Well, now it's going to say, okay, initial debt is too high because with a 1.5 debt service coverage ratio requirement, you can only borrow 8.5 million, but you're borrowing 10.7. So that's not going to work. That's what it's yelling at. So your goal is to kind of do the back and forth of do I think I can get this financing? And can I actually acquire the property at this price and make the renovations that I need in order to increase the net operating income and provide a return for my investors? So once you've kind of got this all working, what you'll want to take a look at is come back to this input distributions model and just make sure a couple of things. You want to look at the cash at the beginning of period. So make sure that this cash number never goes negative. And you also can then play around with the sale assumptions and take a look at what your IRR is going to be based on those sale assumptions. So, all right, I think that is really what I wanted to show you. Thank you for sticking around for a long video. And again, as a thank you, we have left a link to this template down in the description of the video below, but also a link to a form that you can fill out to get a coupon or discount code to take a discount on this particular template. And again, we know there's a lot of complexity here. And so if you have any questions at all, please just reach out to us at support@projectionhub.com. Thanks.